Welcome back to CPAs After Hours with
Z Barfoot, CPA.
and Austin Malone. This is where we talk about the parts of being a CPA that do not show up in textbooks or in CPE courses. Today we're going to be talking about what to do when you make a tax mistake and potentially how to avoid making it in the first place. So if you've ever thought, I made a tax whoopsie, now what? This episode's for you. Z, what is the biggest cleanup project you've seen that did not ruin somebody's life?
We have a guy who had about 5 different businesses and a personal return that he was 7 years behind on. Luckily for him, a lot of those entities were inactive, no profit, no income, and he wrapped them up. So we were able to file the entity 0 way back when, and on his personal, we were able to catch him up. He didn't really owe any tax. He didn't really own anything, so there's not like the IRS could levy anything on him. He had no bank accounts or anything like that. Weird situation. Didn't ruin his life. He got caught up. It cost a small fortune, but I mean, he was in a pickle. He had gone to 3 other CPAs before us. 2 of them died. 1 of them never did anything with the documents, so they were essentially dead. And it took a small fortune to fix it. But, I mean, we were talking about 42 returns, 7 years, 6 different legal entities that are filing, up to 42 returns. That's going to cost a chunk of change.
Okay, so first segment is going to be, it's rarely just one thing. I want us to talk about kind of the messes that we actually see and what all the different pieces of the puzzles are when we have those problems. So what's the first thing that's kind of a red flag to you that, hey, we may have a big cleanup project on our hands?
There's a report called the reconciliation report. You pull that bad boy, and if the reconciliation's never been done, there's a good chance that you have a lot of duplicated income or missed expenses or duplicated expenses and missed income. Hopefully that's not the case. But with all that said, if you're not in reconciliations on a monthly basis and you've had that business for 5-6 years, you don't know if the financials are right. A lot of the time, people send out an invoice and then they'll receive that via check and deposit it. So you have revenue from the invoice that was generated and a check that was generated as in revenue as well inside of your ledger software. If those two aren't matching together, they're not canceling one of them out, so you have duplicated revenue. It happens very, very frequently.
So one thing I think I'll pause and ask as a clarifying question is, if I'm a small business owner and I track my income and expenses in here, why do I care if my financials are bad? I'm still making my money.
This can be deceptive. I tracked my finances in here for a while, and you kind of just live based on what the bank account says. That's very unhealthy. You could have checks in the mail that are more than the cash that you have in your bank. If it's up here, there's a good chance you know that. Sometimes you forget. I've never been perfect. But also, not everything that comes out of that bank account is a deduction. If you're taking money out of your business and putting it in your pocket to pay for personal stuff, that's not a deduction. So your income is generally higher than you think it is on the taxes, which leads to a higher tax bill that you're not anticipating. And it leads to cash flow issues, whether that be in April or January, whenever you decide to pay that tax.
I was going to be a little bit meaner, and I was going to say, you may know that it's all up here in your brain. If anybody's listening to this with no video, they're going to be really confused what we're talking about. Put that into my brain. I don't know what's in your brain. Whoever's doing your sales tax doesn't know what's in your brain. Your payroll people don't know what's in your brain. If you get audited, the IRS person doesn't care what's in your brain. And so you can really mess a lot of things up by sending out these reports that don't make any sense, or by taking a pile of garbage to a CPA and making them figure it out at the end of the year. Because guess what? Sometimes we have to make judgment calls especially if we ask you and you can't tell us what it is, probably it's not going to be the most favorable treatment to you, because we don't want to be in trouble in the event your return gets audited. So, I'm not saying everybody needs to know how to be a CPA, but you should at least have some reports that make sense when you look at them. If your accounts receivable balance has grown from $100,000 to $1 million in 1 year, and you didn't make $1 million, something's wrong.
Something big is wrong.
Okay, so we talked about the financials. We talked a little bit about kind of what problems those can cause. Do you want to jump into some of those?
Financial specifically? Yeah, how are you ever going to grow your business if you don't know what the financials say? Typically, people use these financials, history data is another way to think of it, things that have occurred in the past, to make judgments for the future. So some kind of cool analytics that you can pull from your financials are, what are the costs of an additional employee? How much can an additional employee make me? Or how much time can they take away from me to then make more money? Those are really huge numbers. People often just hire because they need more help, but they don't really understand the cost of the employee or the revenue that the employee is going to generate. And so you're hiring somebody at a loss. That's going to cost you money. That doesn't grow your business or grow your sales. So without financials, how are you going to be able to make those decisions? That's a huge one that I see very frequently. Another one is, I have all this money, but I'm not investing in marketing or sales. That's a fault that I've made. So you can generate a bunch of revenue through marketing and sales, assuming you have some really, really good data on your click rates, what's your conversion rate, every dollar you spend, how much money comes back into your pocket. Without good financials, there's no way you're going to be able to tell what those numbers are.
So I'm going to throw one in here too that hurts even worse. So let's go to that example of you're duplicating revenue in your books, and then you're doing your sales tax off of your books. If you're doing your sales tax right, at least in the state of Arkansas, I know there's some other states that do this as well, you cannot use cash basis reporting for sales tax in Arkansas. You have to do accrual basis, which means you're declaring all that doubled income and paying sales tax on it. You go, oh, that's okay, I'll hire Z and he'll go back and amend all my sales tax returns for me. Now, Z and I disagree on this. Every time I've seen an amended sales tax return, it has resulted in a multi-year sales tax audit. And of all the people you don't want to get audited by, I think sales tax people are the worst. I would much rather do an income tax audit than I would a sales tax audit.
Yeah, sales tax is other people's money. Income tax is your money. They don't play around when it's other people's money.
Okay, so we talked about sales tax. What's another category of problems that these cleanup projects frequently have?
Payroll. We have seen so many issues on the payroll side of things, whether that be we're forgetting or not filing our 941s, our quarterly payroll filings, or our yearly 940s. We switch payroll providers, so there's a gap in filing or there's a duplicate filing. We have decided to quit using a payroll provider because they're horrible and they cost too much, but we don't pick up a new one, and so we just start writing checks to our employees for the rest of the year. That one alone has resulted in somebody owing roughly $90,000 from my latest calculation. What did the notice say from the IRS? $220,000. So yeah, they probably pooped their pants when they got that notice, but we were able to help a little bit. They're still going to owe a ton of money. Payment plan is going to be involved, things of that nature. But that's the cost of not doing business the right way.
Okay, so there's one that I wanted to talk about that's like the worst penalty ever, and it only relates to payroll problems. And so I'm reading off of the IRS website because I don't want CPAs in the comments tell me that I'm making stuff up or that I'm fear-mongering. But essentially, the worst penalty you can be subject to that I'm aware of is the trust fund recovery penalty, and it's for payroll problems. And it's when you essentially withhold the tax and then you do not go and pay it. And so technically they have to prove that you willfully did that. I think that's pretty easy to prove you took it and then you didn't do it, that penalty is equal to 100% of the tax that should have been remitted. So now you're doubling your payroll tax, and it can pierce through the corporate veil to the responsible individuals in the partnership. So let's say me and Z are a partnership, and he starts to pocket the payroll tax that he's taken out of people's checks. I can get on the hook for that, even though I'm not the one who did it, because I'm a responsible individual. So you really don't want to be subject to that one. I haven't really seen that one a ton, but when you do, it gets really, really nasty really, really quickly. And so I wanted to throw that one out. If you want to mess up on something, don't mess up on payroll. Don't mess up on sales tax.
Yeah, I think the sales tax auditors are pretty bad state by state. Arkansas is on top of the game. But payroll, when you're talking about the IRS, that's the one thing that they are on top of is their payroll audits. Income tax, yeah. Payroll, yeah. You don't want to mess with them on payroll.
And those failure to deposit penalties, which are a little different, that's like you just didn't pay it. You didn't like willfully hold somebody else's, right? You just didn't get it where it was supposed to go. It can be 2, 5, 10, or 15%. So they kind of go up depending on how late the money is. So you're talking about real money here. You know, on the income tax side, a lot of times what you see is failure to pay. That's like 1/2 of 1%, or failure to file. That's 5% of the balance due. But we're talking about 15%, so 3 times as bad. And so if you hate taxes, you should avoid penalties as much as possible, because you're paying more for no reason. And they're generally not super nice to you when you're behind.
No.
Especially when you're really behind. The more behind you get, the less empathetic these auditors and revenue agents are.
Every once in a while, I'll schmooze them up, okay? But that doesn't happen every time. You respond very fast. You use all the correct addressing, so Mrs. and things of that nature. But we've probably had 2 agents that were very, very kind, the rest of them not. And it was just case by case.
Yeah, I would just say as a blanket rule, the IRS treats payroll noncompliance a lot more aggressively than income tax balances. There's a little bit more you can do with income tax balances. And it kind of makes sense, right? Because you're talking about employees too, and so they want to protect the public interest. Okay, we kind of skipped over income tax problems.
If you ever want to own anything, make sure you file your taxes, because they can levy, they can take. Assuming that you're collectible, they can make you sell things to pay for items like stocks and interest and dividends. They can take those. So be very, very wary on what you owe versus what you own. We have been in a couple situations where clients don't have the assets to pay, so they have said, you're currently not collectible. That's okay. We will address this in a couple of years in the future.
But the interest and penalty accrues during that time, so that's not a get-out-of-jail-free card. The problem isn't going away. It's getting bigger. They're just not taking your stuff in the meantime.
Yes, so you're kicking the can down the road there. Other solutions are, we're going to take your stuff. And that's about as clear-cut as it gets.
We're going to talk about in a minute the series of letters that you get when you're in that collection scenario, and what each one means, and how ridiculous you look if you send us the last one and pretend like you haven't heard anything from the IRS.
Yes, we do this professionally, so we know if there's been prior letters. We might not be on the power of attorney for you. In short, if you don't know what that is, essentially you can give us permission to talk to the IRS on your behalf. We cannot negotiate. I think we can negotiate payments.
We can,
but we do not.
We don't.
We do not negotiate payments. We do not pay or transfer money. It's literally us writing on your behalf for you to get the best situation possible. That's what that power of attorney document is. And if you have a spouse, your spouse signs it as well. We can represent both of you. You can represent businesses, things of that nature. But if you have that power of attorney, you can pull a transcript of all the letters that you've received, and it doesn't look great.
couple of penalties we're going to run through on the income tax side, just because I know there will be CPAs in the comments asking why we didn't talk about this if we don't. So let's say that you filed your return and you owed money, but you didn't pay it. So you're not going to owe failure to file because you filed it on time, but you are going to owe failure to pay. So that's 1/2 of 1% of the balance due for each month or a part of a month. I'm using the language from the regs. I know that's confusing. Okay, let's say you don't file and you owe it on the return. Now you owe failure to pay and failure to file. There's a max there where they start like cutting you a little bit of slack on this. I think it's 25% of the balance due.
25%.
That's 5% per month or part of a month, up to 25%. Interest accrues no matter what. There's no limitation on interest accrual. It's going to keep going forever and ever and ever. So please don't be angry in the comments.
When I worked at a different firm, I saw where a couple of, I think they were physicians, maybe they were in PT. They didn't file for 20 years. They owned a company, didn't file. At the end of it, they had a note due to the IRS of $1.3 million that they were paying over the course of 20 years. So they basically had a house, a really nice house, that they were never going to get to live in. They were just making these huge mortgage-sized payments to the IRS. And the amortization schedule, I saw how much they paid. One year was like 50-something thousand. The principal went down like 10. It was very, very sad to see. But they dug their own grave on that one.
Okay, so we've got a lot left to cover in our last 10 minutes here, but I thought it'd be fun to throw you out some fact patterns, and you can tell me how bad these scenarios are on a scale of 1 to 10.
Sure.
Okay, scenario number 1. I owe $8,000 from last year, but I filed on time.
Not bad.
Like a 2 or a 3.
Not bad, yeah. They're very minimal.
Okay, I have 2 years of unfiled personal returns I owe on both years.
Depends on how much they owe. If it's less than $1,000, not bad. If that's also a personal question, person by person, right? $5,000 might not be anything to somebody, but it might be a ton to another person. But as far as the penalties and stuff accrued on it, probably like a 5 out of 10.
And if you were somebody in that band of owing money, you're going to automatically apply for installment agreements. You're going to be accepted without any, like, having to talk to somebody on the phone. So if you get in a pinch where you can't pay it like that, the resolution is pretty easy. You could also pay it on some other method with a lower interest rate.
And assuming that you've been compliant and filing on time for the prior 3 years, before those two years of non-filing, you're not going to have any penalties on that first year of non-filing. So the bulk of your penalties are not going to be applied. If you ask, all you have to do is ask.
Okay, the next one is I have 3/4 of unpaid 941 deposits.
That's hard. That's probably like an 8 out of 10. I hope you got the money.
Okay, next one is I received a CP 2000 notice. That's like a mismatch.
1 out of 10.
Yeah, those you just need to respond to them. If you respond to those really early, most of the time it's going to be a no adjustment situation.
I had a guy, he was head of a nonprofit, and he set up a Cash App in his personal name. If you're watching this, you know who I'm talking about. He set up a Cash App in his personal name. They received like $30,000 to that Cash App, and he would just move that money from him to the nonprofit bank account. Really, really easy. Like I said, he was the president of the organization at the time. That Cash App sent the IRS a 1099 saying, hey, this guy made 30-something thousand. This is his social. So when he didn't put that 30-something thousand on his tax return, well, then he's going to get a notice. They're going to say, you owe us 18 grand. You owe us self-employment tax. You owe us federal income tax. You owe us penalties and interest. And he did that for 4 years. It took us a couple hours to fix. No problem. You put the money on the return. You take it off the return without getting into specifics. But super easy. 1 out of 10 for sure.
Next one, I get a letter 1058. It says on the top, final notice of intent to levy.
That's bad.
That is like the very last stage before you basically lose all your rights and you're stuck with it.
Yeah, that's out of all of them, probably 10 out of 10.
All you've got left at that point is a collection due process hearing, which you're probably not going to feel comfortable requesting by yourself. You're now in either tax attorney or CPA territory for the most part, if it's any substantial. And then the last one, the revenue office comes by my business after hours and leaves their business card taped to my door.
They didn't give you a letter.
If they come to you, it's bad. If they're sending letters, it's usually not as bad. If they're coming to you out in the field, that's pretty unusual.
It could be a random field audit. That happens.
I've seen one of those recently, and the clients would not say that was inconsequential, but that's okay. So those were our situations. Now we're going to switch into a different segment, and this is probably going to be one where I talk a little bit more. Sorry in advance if you prefer Z. But it's about what actually happens in collections, because we get a lot of questions on this, and I think people get really scared really early on because of the way that they send letters. And so my goal here is for when you get those letters, for you to understand what's happening, and maybe you can act on it without all the fear, right? So the first thing is there's a difference between assessment of tax and collection of tax. So the first thing you're going to get from the IRS is an assessment, and that's basically them saying you owe this much tax. So sometimes they'll do that from scratch. Like if you haven't filed returns, sometimes they'll do a substitute for return, and they'll just make up numbers. And rarely do those numbers make any sense at all.
Right.
They can't collect until the tax has been assessed. So that's their way of starting the timer, kind of. You can contest that assessment, present evidence to the contrary, get your returns filed to replace that assessment. You're not locked in to that balance yet. And I would say this is before a lot of times the actual revenue agent or officer has been assigned. A lot of times this is like an automated process. And so the majority of the time, this is the easiest place to resolve stuff if you can catch it early. Whereas if you let it go into the collection territory, now you're dealing with somebody who gets evaluated on whether or not they take people's money.
You want to talk about a tournament fishing situation?
I'm going to wait till we get to the audit part. Okay. So assessment generally happens, you start that clock when you file your own return. So the best thing you can do if you're afraid of the IRS assessing is to file your own return on time. And that's going to start your timer. The sooner you start it, the better. If you leave your returns unfiled, that timer never starts.
And what is that timer?
Oh, hellfire.
7 years.
Well, it's different for collection. So I know collection is 10 years. Statute of limitation. This is real life research. For assessment. Generally 3 days from the date of filing, and then there's some exceptions for 6 years or no limit if it's intentional fraud. So it kind of varies, but all I want you to know is when you don't file your tax returns, you're leaving yourself open theoretically forever. And so that's almost never a good idea. Okay, so then they're going to start collecting, and then once they start trying to collect, when that assessment becomes final, they've got 10 years to get the money. So if you can somehow hunker down for 10 years after they have started to try and collect, they will eventually write that balance off. That's not a great way to do it because they're going to issue liens. They're going to attempt to levy any bank accounts you've got in the interim. So you're kind of like playing whack-a-mole. We've seen some clients that tried to do that. You're usually not super successful. They're pretty good at freezing your stuff. There's some really good videos on YouTube if you're curious, like what all the IRS knows about you when they begin auditing or collecting. And it is kind of crazy, the amount of stuff they know. And they will ask you, this is one of the crazy things too, they'll make you fill out all these forms when you're going through the collection process with all this data they already have. And basically what they're trying to do is catch you up in a fib. They know the accounts that you've got, the relative balances.
They know the color car that you purchased.
Yep.
It's crazy.
There are some things that stop that 10-year timer. So a lot of these administrative things that we've talked about, will stop the timer. So if you like apply for an installment agreement and they haven't approved it yet, that pauses the timer. If you request that collection due process hearing we talked about, that pauses the timer until you've had it. If you try to do an offer in compromise, that pauses the timer. If you try to declare bankruptcy, that's going to pause the timer. So I'm just throwing that out there again for the CPAs that may be in the comments looking to get us caught up. Really quickly, because we've got like 2 minutes left, I want to run through the typical progression of notices. So the first notice you're generally going to get is a CP14 unless it's a CP2000. We said the CP2000 says, here's what the IRS had, here's what you had, there's a difference, tell us why. That one's not a huge deal. CP14 is going to be one where they actually tell you this is what you owe. So we would like for you to pay this. You could still contest that. After a while, they're going to send you a CP501. That's like a reminder. The assessment is still not final, but they're inviting you to respond. This is a great time to go ahead and do it. There's a CP503. They're saying that you need to respond immediately, or they're going to move on to the next stage. And then the CP504 says we are intending to levy. So we are going to move into the collection process. And then that last one, the scary one, is letter 1058. It says, hey, we have final notice of intent to levy. We are going to place a lien on your stuff, and then we're going to start seizing your assets. And that's when you have a ability to request that last-ditch hearing to present your evidence before that assessment becomes final. So I said a couple of words there that you may not know. One of them was lien, and one of them is levy. So let's talk about the difference between a lien and a levy. A lot of CPAs don't know this, actually. So a lien is a claim to something. So like, if you've heard of, like when you go register your car, they want a certificate from the lien holder. That means somebody with a claim against the underlying property. So a federal tax lien is just sort of your tax balance that attaches to some kind of asset. And so it sort of mimics your interest in the property. So they can take up to whatever your interest in it is. That's a little bit of a complicated concept that we don't have time to talk about today, but essentially, it's publicly available, so people can go and search and see that you owe taxes at this point. When you have a lien, it's going to damage your credit, and then if you go to sell something, they are going to take the proceeds that they're owed first. So we've seen that before, where somebody tries to sell their house, they had a lien on it, and then the government takes their money out before you get yours. And sometimes it wipes out the cash you thought you were going to get. The levy is different. So a levy is when they're actually going to take the thing. And so you most commonly see this on a bank account. When they do that, notice of intent to levy, they will issue a lien on the bank account. Once they issue the lien, there's a 21-day period before they take the cash, and then it's theirs. What's kind of interesting is each levy is like a separate event. So sometimes you'll see like a couple of smaller amounts come through, and it's based on like the bank account balance. So your bank account balance fluctuates. They can't take more than you've got, right? So let's say you owe $10,000, but you have $1,000 in your bank account. They'll levy it for $1,000. And then you have $2,000 in it next month. They'll levy it again, take $2,000, on and on and on until they've paid off the lien, which was the $10,000 they initially assessed. That 21-day timer is a time when you can get in there and try to get like an alternative collection plan approved. It's kind of the worst place to be because you're in a compressed timeline, so very few firms are set up to deal with you on that compressed of a timeline. So if you get to that point, I'm going to say that you have already kind of lost because you've lost an ability to do the administrative processes. And then typically when you get into the collection process and you've got a lien or a levy, there's a revenue officer assigned. On a smaller balance, that might not be the case, but the bigger the balance, the higher likelihood you're going to have a revenue agent. You're probably going to have a field visit or like a lot of letters coming from them with like handwritten requests. That's how you know you're in trouble. If they're paying somebody to sit down with a pen, you're in trouble. They're going to be more aggressive. They're going to require you to disclose a bunch of financial information that's going to be kind of burdensome. Your negotiation leverage is generally a lot less at this stage. So if you get into this scenario, I'm going to throw out some things you can think of, and then we're kind of going to wrap for the day. We're a little bit over already. If you know that you owe the money and you know the assessment is right, but you just got behind and you can't pay it all at once, the easiest thing to do is get an installment agreement. If it's under $50,000 for an individual, it's going to be generally automatically approved. If it's under $25,000 for a business, generally automatically approved. Basically, you don't have to tell them anything. You go in online, you can do it yourself. It's like a 5-minute process. If you have a really high balance, you're going to have to fill out some forms, either 433A or 433B, depending on whether you're an individual or a business. It's going to be based on your ability to pay, and oh my God, the ability to pay that they come up with sometimes is ridiculous. They're going to include basically what your business nets each month, so like your income available to you, and your interest in all of your assets. And so like we had a guy, and he keeps about 1 month of operating expenses in the bank account, and he nets about $1,900 a month. They expect him to give up $1,900 a month and give up all his cash immediately. Well, if he does that, it's going to bankrupt his business. But that's what the law says is his ability to pay. It's a statutory formula. The next one's offer and compromise. This one is advertised all the time on the radio. If you've ever been in the liquor store, there's like a 90% possibility that you heard a offer and compromise ad on the radio. Essentially, they say, we're never going to get the money out of you because you're too broke, so we'll settle the tax for less than what we assessed. It is really, really strict on your financial situation. It is not super common to see these actually get approved, but a lot of people use it to get you in the door and close you on tax representation fees. They'll apply for this knowing you're going to lose, and then they did the work, so you've already paid for it. So we will evaluate that on somebody if they have a big balance. I'll investigate and see, is it likely that you would qualify for that? But a lot of times we don't pursue it because I know how it's going to shake out, and all it does is waste time and shorten that or lengthen the collection window.
And cost the taxpayer even more money they don't have.
Yes.
It's horrible.
And then the last one's currently not collectible. This is kind of the hardest one to qualify for. Basically, they say eventually you'll have the money to pay, but you don't right now, so you still owe the money, but we will stop trying to take your stuff in the meantime. And then the last one, this really isn't a tax resolution thing, but penalty abatement. So if a large portion of the balance that you owe is penalties, there are different regimes for penalty relief, and so you can be kind of strategic in what period you select for relief. But most of these collection alternatives that you're going to try to do to reduce what you pay in are going to require you to be in compliance. So we're circling back now to the filings. If you are not caught up on your filings, the IRS is not going to want to work with you. So a lot of times let's say we're dealing with somebody that's several years behind. The way that I'll begin the negotiation when that revenue officer comes in is they have to make progress on the case. I'll say, hey, can we hold it right here, and I'll deliver you one tax return every 2 weeks until they're caught up. And they like to see compliance, and they don't want to have to make up the returns themselves anyways because they're kind of lazy most of the time. And that will usually satisfy them. Sometimes it won't, depends on the dollar amount of the balance, but if you can make their lives easier, a lot of times they'll kind of work with you. So, Z, do you want to close us out with a couple of things you can do as a client to avoid becoming a cleanup project?
Yes, for sure. One thing you're going to want to do is stay up to date on your filings. If you cannot do it on your own, you need to pay somebody to help you stay up to date. Number 2, it's really easy to do your filings when you have a checklist of everything that you need. There's organizers that we generate for our clients. There's online organizers you could probably find. Creating a list of documents you need every year. Don't become a cleanup project. Number 3, pay your tax. Nobody likes to pay it. I've never met somebody who's for higher taxes when it comes time to pay them. But with that in mind, if you don't pay your fair share or whatever they deem as fair, you will become a cleanup project and have a lot of IRS correspondence, and it'll cost you more in time than you think it's worth, most likely. And lastly, do you have anything else to add?
Yeah, so I'm going to say if you're somebody who gets nervous about taxes, I had a client ask this one time when I was in a consult, when I was working under another CPA, and I had never heard anybody ask it since or before that. and it was, on a scale of 1 to 10, how defensible is my return under audit? I love that question, because as a general rule, I'm not going to go to a client and be like, I think that you're a tax cheat, right? I'm going to generally assume that they are giving me stuff that is correct. When they ask me that question, now I'm going to change the way that I look at it, and I'm going to pretend that I am an auditor now, and I'm going to look and I'm going to say, if I were going to try and tear apart this return as an outsider looking in, here's where I would look, here are the risk factors, and I'm going to know, based on working with you and questions I ask as a follow-up, whether or not you're likely to survive that audit. Because we don't see the bookkeeping in all our clients. But if you ask me that question, now I can say, well, how often do you reconcile your checking account? What does your receivables process look like? Things like that.
Last bit of advice before we wrap up. If you're worried about what they're going to look for under audits, pull the ATG guide for your business. That is the audit technique guide, publicly available to everybody. Shows you the playbook that the IRS auditor has that they go through during an audit. But I think our time is up. Thank you so much for watching, and we really appreciate you tuning in. See you next time.